The Federal Reserve has raised interest rates officially for the first time since 2018. The question now, as we enter this new interest rate hike cycle, is can the Federal Reserve and other central banks around the world navigate this uncertain period and stick the soft landing, and most importantly, avoid sending the US and global economies into recession? It's an important question. Today we're going to unpack this. We'll talk about what this soft landing actually is. We'll discuss a soft and a hard landing, how they may look. And make sure you stay until the end because we'll actually discuss whether there's been any examples of soft landing in history and how the Federal Reserve and other central banks could look to emulate this with this upcoming period. Of course, before we unpack all of that, it makes sense for us to think about the current situation. As I'm sure everybody's familiar with now, inflation's been running hot. In the US market, we've got record high inflation, the hottest in the past 40 plus years. 7.9% was the last print. But of course, with all of the uncertainty in Ukraine and Europe, the supply chain pressure that has put on, and the continued inflationary pressures that have flowed through, it's likely that we could continue to see hot inflation over this upcoming period. We had the first Federal Reserve rate hike since 2018, 25 basis points, but we did get a new dot plot. And the dot plot indicates that we may have up to 6 rate hikes in 2022 before another 4 in 2023. With that neutral rate in between that 2 to 3% band, as has previously been discussed. Of course, the question is now, with everything that's playing out, what happens from here? And what is this whole soft landing? And so here we have it, the soft landing. What exactly is sticking the soft landing? What are the implications that it could have for global economies and the markets? Here are a couple of really interesting visuals that I came across that really help to conceptualize this soft or hard landing. As we can see here on the left, we see the soft landing is a smooth landing. It allows us to arrive at a stable inflation point, which means that we can continue to facilitate sustained economic growth, though of course it is not overheating and out of control. While on the other side, we see inflation getting out of control. And once you're trying to navigate a soft landing, once you're above the point of no return, it can be very difficult to navigate that. And what has traditionally happened is that we see the economies heading into recession. But we'll unpack both of these in more detail throughout the video. I'd love to know your thoughts on it all too, so drop in a comment below what you think about the current state of the economic picture, and how do you think we're going to go with this upcoming period into 2022 and beyond. So really delving deeper into that soft landing discussion. As we know, the economy goes through periods of expansion and prosperity before we have booms, and then also back through to recessions, and then we cycle through. The markets, the economy, they're cyclical in nature. But of course, this soft landing here is a cyclical downturn that tries to avoid recession. We can never avoid recessions forever, of course. The markets go through cycles like anything else in life. But the soft landing is trying to avoid the overheating in the economy, slowing down, pumping the brakes on an economy that's running hot, but trying to avoid that recession. The way that central banks aim to do that is to raise interest rates to stop that overheating. But of course, what they're trying to avoid is hindering growth, and of course ensuring that they don't limit and restrict a robust and strong labour market. They aim to reduce demand by raising interest rates, which ultimately will have implications of lowering prices throughout the economy as workers and firms and other market participants accept lower prices as a result of all of this. Ultimately, they're aiming for a moderate economic contraction without a recession. It sounds easy on paper, but navigating a soft landing of course has a huge number of inputs. And so starting with a soft landing, this is where the economy avoids that overheating without derailing the recovery. As we know, the Federal Reserve, as well as other central banks around the world, have targeted that 2 to 3% band for inflation. They want to see that sustainably. They believe that's the happy level where we see sustained growth that can be continued on. It's prosperity for the broader economy, but it doesn't mean that we're overheating. And it can be sustained, and it means that the cost of living and, of course, living standards can be consistent. Now, we have been overheating that over this past period. As we know, we're overreaching 7.9%, core inflation in around that 5% band. However, a lot of this has been contributed to with the supply chain bottlenecks, which of course the central banks are hoping will subside as we get into the back end of this year. We have heard the transitory language starting to be now replaced with, yes, this is more persistent than we initially thought. However, we're trying to see now whether this is systemic inflation or whether it's more persistent inflation than was initially anticipated, but it will start to fade at the back end of this year, particularly as we move through this virus period. Because as we know, the virus, lockdowns, all of the additional measures that have to go with the virus, they are inflationary in nature too. But on the other side of the coin is that hard landing discussion. This is where rates must be raised significantly and quickly. There's a swift velocity to it. And unfortunately, this is where we send economies into slowdowns and potentially recessions in the worst case scenario. Of course, we know that the Federal Reserve has targeted inflation. That's their mandate that they want to focus on at the moment. But what's hard about it is that once inflation gets out of control, a soft landing from the top can be very, very hard to really maneuver. Now, it doesn't mean it's impossible, but the question is now, have central banks waited too long, or is this the right time for them to be doing it? We know there's been coordinated monetary policy and fiscal support over the past 2 years to help us out of this recession that we saw, of course, with the virus and everything that played out with that. We know that we needed that support, but we now need to move out from this crisis time, emergency time, monetary policy support and allow this economic recovery to stand on its own 2 feet. So this is what the central banks are trying to discuss, they're trying to play with. And the question is, can they stick the landing? It's a fascinating discussion and one that we'll continue to watch for insights moving forward. And so with all of that, you might be wondering, now has this happened before? What we can see here is 3 different examples. These were ones that Jerome Powell, the Federal Reserve Chairman, discussed in one of his recent speeches, about 3 examples of soft landings that were stuck well. Now what we can see here on the visuals is, in the black, the federal funds rate, the interest rate. Now in the blue, we see the unemployment rate, and then in the gold, we see core inflation. These are 3 of the key inputs and the 3 levers that, of course, the Fed, as well as other central banks like the RBA, will be focusing on. We can see here that in the 60s, in the 80s, of course, with the great inflation and then the recession that happened during that period, and then 1994 and 95. During those periods, we saw the federal funds rate need to be raised. Now, it is worth noting that they were slightly different market conditions in the fact that there they were trying to curtail or keep a lid on inflation, but now we're actively trying to bring inflation down. Though, of course, we've had that previous discussion that the hopes are a lot of the inflationary pressures will begin to subside as supply chain bottlenecks and the virus goes into the rearview mirror. We did see unemployment, of course, was at a far higher rate there. We see 6% as well as 10%, depending on which period you're looking at now. We're in a much tighter labour market, which makes it more difficult to navigate in this upcoming period. But we can see that they did manage to stick the soft landing with a number of these different cases. And this is what the Federal Reserve is pointing to, with the aspirations that hopefully this period will be somewhat similar. Though, of course, we know that history never repeats, but often it does rhyme. And so then bringing all of that together, the question is, what to watch? First and foremost, if you've enjoyed the video, don't forget to hit the like button. Feel free to share it out. If you're new here, we make a daily video each and every day, so make sure you've subscribed, turn your bell notifications on as well. The question is, what to watch? There's a few different factors here. First and foremost, how high and how fast will the Federal Reserve raise rates? Now, a lot of this will, of course, be a result of the changing macroeconomic landscape that we see. They don't have all the answers now. They're going to be data dependent, but this is going to be a key factor to consider. Of course, will the supply chain bottlenecks begin to ease? The thoughts are they will, but we have to see at what magnitude and at what velocity they do. And then we all are aware of the geopolitical situation in Ukraine and Europe. Economic sanctions continue to be delivered there. We're hoping first and foremost for a solution that's swift and safe for as many people there. We know it's a humanitarian crisis first and foremost, but of course it does have implications for the broader market too. Then I think, how will consumers respond with rising prices? So far, they've been able to digest them pretty well. We know there's a high household saving rate. Of course, we've seen a lot of these companies be able to pass on these rising costs onto the consumers, and so far demand hasn't been reduced too much. But the question is, if inflation continues to remain sustained, will we see demand destruction can start to flow through the economy? And then the question is, have we left the virus behind us? As we talked about before, the virus and all of the supporting measures, the increased focus on the virus, it has been inflationary in nature. Another outbreak, of course, would be terrible to consider, the world back into lockdown, but we can't put it out of the question. With everything that we've seen play out over this past period, it's worth being cognizant of. So ultimately, the Federal Reserve, they've got an important role. However, there are still many uncertainties, and it's not only the central banks that will be able to help to navigate this soft landing, but a lot of it has to do with the nature of how the macroeconomic landscape plays out and all of these different competing narratives. We've got a range of different videos on the channel into different macroeconomic looks that we've done over the past period. We'll leave links to those up above. Hope you enjoyed this video. Thank you so much for joining us. Drop in a comment and let us know what you think. For now, stay well and happy investing.